From the morning reading, post-Brexit, broad rally day 2, the close at Friday's high. Nike positive earnings per share reaction, oil rallies again. All 9 sectors moved higher on Wednesday. XLF, XLV, and XLE were the strongest sectors, while XLU was the weakest sector for the second straight day. Oil futures rose $1.43 to close at $49.54. Breath held steady as advancers led 2621 to 442 on the New York Stock Exchange and 2060 to 575 on the NASDAQ. On the S&P 500 snapshot, we're back into the green for the year to date. On a global basis, equity markets have essentially discounted last week's Brexit vote. Today's rally to 1 decimal place put the Nikkei up 1.6%, the DAX 1.8%, and the CAC up 2.6%, and the FTSE up 3.6%. Our benchmark S&P 500 rose 1.7% today, just a tad off its 1.82% intraday high shortly before the close. The index is back in the green year-to-date, up 1.31%. Another big thrust on Wednesday triggered the 90% up volume day. The last time the New York Stock Exchange volume was so heavily focused on advancing stocks on consecutive days was in January of 2013, and there haven't been that many occurrences besides that. All of them were bullish for the medium term. Even if we relax the parameters, medium-term returns in the S&P 500 going forward were exceptional. The last time we had big back-to-back gains following big back-to-back losses was 2011. Going back further, such reversals tended to lead to modest upside in the medium term, but not so much shorter term. The S&P had a stronger tendency to give back some of the gains in the weeks ahead. There is a mild positive seasonality ahead of the holiday, negative after. SPDR rose the day before Independence Day holiday 65% of the time, including 7 of the last 10 years, but the day after only 35% of the time, only 2 of the last 10 years. Another gap up on Thursday would be a poor setup for late buyers. When SPDR is gapped up by any amount following 2 days when it gapped up by 0.5% or more, the opening of the third gap to 4 days later, the SPDR showed a positive return only 23 out of 60 times, averaging a negative 0.8%. It didn't improve at all since 2009, so it's not limited to bear markets. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:18 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 30th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report, and again, positive, but not in an enormous way. At the time of this cut, the S&P futures were up just above scratch. The Russell futures were up about 0.25%, NASDAQ up just above scratch, as was the Dow. Crude oil down about 1.3%, euro up just above scratch, bonds down about 0.5%, the first time we've seen any significant weakness coming out of bonds in recent days. Gold is down about 0.5%. And the overseas markets, China down just below scratch, Hong Kong up about 1.75%, Japan up just above scratch, as is Germany and the United Kingdom. In macroeconomic reports for today in the United States, you had the weekly version of the unemployment claims, Chicago PMI, nat gas storage, and that looks to be about it for the United States. In terms of looking forward to tomorrow, we have ISM manufacturing PMI and several more minor reports not likely to be market movers. In terms of volatility, volatility has been getting crushed, and short-term VIX is now down to a 15.86, a skew, still in warning status, but well down from where it was, 136.46. IV percentile also falling pretty dramatically. These were running up around 50 at one point, and with the S&P now at a 21, the Russell at a 29, the NASDAQ at a 19, and the Dow at a 17. We still continue to have a lot of volatility and a really whippy market. In the last 4 sessions, perhaps 5 sessions, if you're looking at the Russell and the Dow, have had standard deviation moves in every single day. And obviously you started with Friday with a -3 standard deviation move, followed with a -1, and now back-to-back days of up 1 standard deviation moves in the S&P. Even more dramatic has been in the Russell, where you went +1, -3, -2, +1, +1. So an awful lot of movement and volatility in the last few trading sessions, and not just the immediate post-Brexit vote, but now 3 trading sessions post that vote day. We now have quite a run of volatility. This is dropping, though, and we're certainly not seeing the kinds of fear that was present in those hours after the Brexit vote's results became known. In terms of the charts, let's go ahead and go over there. And you see, we're going to use the futures charts. You see the huge move, and I had the fib retracement from the high to low of the big recent move from February to the recent highs, and then I drew a retracement from just this most recent post-Brexit vote. And you see we've retraced over 61.8%. That's the fib retracement. If you had stopped somewhere between this 50 to 618 and then reversed, that would not have been shocking. So the fact that the bulls were able to power through the 618, now we've had a little bit of retracement since, and we're sitting right back at that level right now. We'll have to see if that was just a bit of an overshoot, and indeed we start in the next leg down, or have the bulls been able to shoot past what would normally have been a point in which many traders would have reversed and see a continuation pattern. So we may see something of a flag pattern. The question is, given where we are, it's not entirely obvious as to whether this is setting up as a bear flag and the next leg is down, or if this is now in a short-term bull flag pattern and the next leg is up. So that's kind of where you get left when you have this kind of volatility and whippiness. Which pattern is dominating? Is it the intermediate term? Is it the short term? Is it the very short term? You know, where are the dominant hands in all of this? Not entirely clear, at least to me. In terms of SPX, let's look at and see what the all cash market is doing, and you see that came right up and closed just below the 50% retracement of this recent move. So that's not as important because obviously this is more of a retracement here, but I thought that of some interest. I'm going to go ahead and delete that pattern now, though, because I don't think that is as important going forward as it was up to this point. In terms of where do we go now, again, it's not entirely clear. In terms of the YM, you see a very similar pattern on the YM, again, very closely correlated in recent action. NASDAQ seems to be doing the same thing, and Russell, very much the same thing. So the small consolidation retracement after back-to-back up standard deviation moves, size moves, you know, where do we go from here? Let's see if some of these other correlating or inversely correlated markets are telling us anything. In terms of volatility, we absolutely had the vol crush. We look for that signal by having a spike where you have a close that is more than 3 3 points above the prior close, and we definitely had that with this day on 624. And then we look for a close that's at least 3 points below the high of that spike day, and we had that with this day on 628, and then that has since followed through. So from a high of some 27.6, we now are trading in around the 17.9 handle, so below 18. That has some implications to our systems. That's using the VIX futures, and you see the regular VIX product also below an 18 at this point. So big time vol crush after that event. And when you see those kinds of events, that this is a pretty typical pattern to where you get this spike in volatility, and then as soon as people kind of settle down and understand the implications, at least the short to intermediate term, they kind of settle that into the pricing of specific companies, specific industry groups, specific sectors. And it's not just sell everything, but it's sell for specific things and buy more specific things, and that vol crush starts to develop. In terms of bonds, bonds have been, of course, on a big breakout spike, and they have consolidated a little bit. It would seem that this is setting up for a bull flag, and that would argue that this pattern continues. If the pattern is to continue, that would be bearish for the equity market. Let's look at gold. Of course, it was a safe haven status during this move, and it has a pattern very much like bonds at this point. Normally, if gold is going up, if it's because of safe haven status, that means that equities would be going down as well. And I think that's everything we need to take a look at on the charts. Let's go ahead and go to the daily report. And not too many changes today from yesterday. On our upper level, we're still market phase 5 for that intermediate term phase opinion, the end short term, the break of horizontal diagonal support. We've had a significant move up yet, but I'll have to double check, but I don't think we've had quite enough move to be able to flip this back in to a phase 1 or 2 quite yet. In terms of the 3 market timing signals, IBD still in a sell market and correction signal. GMI index also in a sell signal. So 2 out of the 3 signals are outright sell signals. In fact, in the GMI index, that author is move to cash. In terms of the third signal, the the stock charts decision point scoreboard, it is decidedly moved against you in the short to increasingly intermediate term. All the short-term signals are still neutral to bearish. Intermediate term started deteriorating a few sessions ago and has not yet resolved back into the green. Of course, the long-term backdrop is still decidedly mixed. So the consensus of these signals is that we are a market in transition once again, but the bias now is to the bearish side until proven otherwise. As such, your position sizing opinions for a portfolio are 0%, and for the active trader using a volatility measure is at 75%. Now, with that vol crush, that position sizing model popped back fairly quickly. But given the market and correction signal, that we still have the regular portfolio alongside exposure at 0. In the intermediate term market posture, this continues to be very weak even after back-to-back sessions that were quite strong. And indeed, all 4 indices are still in the strong bear category for the intermediate term market posture. In terms of hedge warning status, we still retain level 2, which is a red light. If we continue to improve, if this pattern sets up as a bull flag pattern, we'll start to see this come down. We'll also start to see this intermediate term market posture turn probably into a weak bull initially. When we see those things happen, then we may see some reduction in the hedge warning status. But right now, the signals still have us pointed to a negative bias. In terms of special opinions, the option income strategy, I still have it as VIX is not acceptable to initiate new positions. Technically, with yesterday's close, we did drop back into the window. You may, if you're a novice trader, start to dip your toe back in. But certainly consider reduced position size. First day back, you usually like to have a little bit more confirmation for most novice traders before you resume your normal option income strategies. Covered call strategies and put selling, conditions not acceptable to initiate new positions for novice traders until the market stabilizes. So we're starting to see some signs of this market stabilization for sure. But after the kinds of moves that we had, we've had back-to-back one standard deviation moves back to the upside, and yet at the same time, we're still, we're not back where we started. We're about a half to maybe, more than 60% of the way back. It's remarkable. It certainly has stabilized from where we were on Monday, but a little bit more caution and defensive-ness is called for when you're talking about novice traders. Now, more aggressive traders may be dipping toes in water with especially defensive setups, a 2-to-1 ratio of in-the-money, out-of-the-money strikes, 2-to-1 ratio of low beta, high beta, and perhaps even just using put spreads to leg in to those covered calls. If you are using put spreads, and that certainly is an outstanding approach to use at this kind of market phase, consider reduced position size and certainly scale to the position size that you're willing to own. Would all be very much called for. In terms of specific warnings, we still have market in decline is present, but you notice we're starting to see a bit more black in here. So not quite as dire as it was a couple sessions ago. Distribution days still in market and correction situations. Skew is still elevated. The current 10-day expected move on the SPX has been continuing to drop. It's still in warning stage at over 40, but this was up over 80. It went down to over 70, over 60, over 50. Now it's down to only over 40. So definitely coming down on that measure. Trend base all still quite red, though the New York Stock Exchange new highs, new lows almost had a signal that would be a bullish signal at over 300 on the new highs. One of the things that we're going to continue to watch is this key intermarket risk aversion indicator. Now all 5 still risk off. We're starting to see some evidence of rolling up, but we're a long way from crossover on those. So some, green shoots, use the old term, some green shoots, but not yet an all clear signal. In terms of sentiment, short-term stocks somewhat elevated at a 7 out of 10. And the fear and greed index up to a 60 now. So remember, yesterday it was a 46. So starting to pop back up towards the greed side on the sentiment indicators. In terms of sector specific, it's quite a Christmas tree here in the market posture. And keep in mind, so many of these lines are still relatively flat as we have whipped back and forth, back and forth. And so it doesn't take that much of a move for some of these to go from green, green, green to down, 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 and back to green, green, green. So these probably, they're helpful, especially when we look for consistency, which sectors are performing the best. Utilities, consumer staples, telecom, those 3 sectors continue to seemingly be the ones that are in the green, not just in the market postures across the 3 time frames, but often in their percent change. Now, utilities, of course, on a big up day are usually not going to be the one that's at the top, and you see, indeed, it's at the bottom. And indeed, consumer staples, telecom, and utilities, and I think this is back-to-back days now, that they are in the worst performing percent change, and yet you got to respect the fact as you look across here, 1 day, 5 day, 1 month, 3 month, year to date, 1 year, those are the 3 sectors that have been most consistent in their performance. And indeed, in the terms of the 12-month performance, they're the ones that are giving you something and getting you ahead of the game, while many of these others are been much more volatile in this range-bound market as you whip back and forth, and then ultimately not to really gain anything. And you see the year-to-dates as well as the one-year numbers for some of these higher beta sectors. So this is definitely a stock picker's market. It's also one in which defensive plays, such as the use of covered calls or very selective plays in consumer staples, telecom, utilities, etc., have been rewarded, where sticking your foot out into anything more aggressive has been a very, very short-term game and not much reward in the long haul as of this point. So something to kind of keep in mind there. So we're right at 20 minutes. Let's go ahead and roll this thing up for today. I will mention that if you want to follow us on the YouTube, we very much welcome that. We've got over 200 people or regular, in quotes, subscribers to the YouTube channel. And that is to say that they have gone to this hyperlink on YouTube and then hit the subscribe button. That's a free subscription, but that does give the subscribers notice when content's actually posted. Also, of course, if you're using the YouTube, as you should be, make sure you're following this in high def. Go to the little gear button, make sure it shows that HD. You get much sharper resolution. You can also resize this to full screen if you want. And then lastly, the other button I generally want to suggest is that you use the playback probably at about 1.5. You could probably understand much of what I'm saying at a faster speed than it actually takes me to record and speak. So that can take a 20-minute video and cut it down to about a 13-minute. So that will give you the information that you need without taking any undue amount of time in your busy morning schedule. So something to think about there. And we're going to go ahead and roll to the disclaimers. Disclaimers is always hit the pause button if you need more time to review the disclaimers, and of course note the hyperlink here at the bottom for the full set of disclosures. We'll see you back here for the next trading session from Falcon Global with our market preview. In the meantime, manage that risk always, and good trading.